Hello, everyone. Welcome to video 3 for chapter 6. So we've talked about the source concept. We've talked about how the inclusion, the 9, 12, 18, 20 rule for computing net income from business. So let's take a look of some of that in action, starting with some business income inclusions. So, from accounting, we know that businesses report on an accrual standpoint, whereas employment income is on a cash basis. So, the Tax Act has measures to use the cash basis, but to approximate the accrual through additions and subtractions from income. Now, there are special rules around farming and fishing businesses. They are allowed to use the cash basis, but that is specific to those businesses. Most businesses have to use the sections in Tax Act 12 to codify their accrual basis. So, for example, when we discuss amounts received or receivable, those should be included in income because we earned those amounts if there's absolute and unconditional right to receive the amount. So I've provided a product or service to someone, I've earned that receivable, but I have not yet received the cash yet. So if we use the cash basis, that amount would not be included in income because the cash hasn't been received. So the Section 12 of the Tax Act codifies that we should recognize this amount in income. It applies to sale of products and provisions of services, and the amount is deemed receivable at the earlier of day that invoice was actually sent, and invoice would have been sent if no undue delay. Invoices are usually sent when the product or service is provided. So the invoice is basically the documentation with the date saying when did I earn it. Um, the thing to focus on is the unconditional right to receive the amount. Oftentimes, even though we've earned a certain amount of income, a portion of our earnings may be set or conditional. Uh, you get this a lot in construction and contract basis, where yes, we've given you X amount of dollars to perform a service or to construct something, but that construction isn't considered complete until certain tests and inspections are completed. So they will do something called holdbacks, where certain receivable amounts will be set aside, and you will not be paid that final amount until the inspection's cleared and the project's officially considered done. So that is a condition on your right to receive the amount. So if we were to look at an example of this in exercise 6-3, you are in the construction business. You've completed the construction of a custom-made residential home. The construction is completed at the end of December 2025. We invoice the customer $600,000 as agreed by the contract, but the contract calls for a holdback of 10% or 10% of the contract price, that being the 600,000. So 10% of 600,000 is $60,000. 60,000, 10% is on condition of architectural approval. The approval requires an on-site investigation, which won't occur until January 2026. The fiscal period ends December 31st. So our invoice, the project was completed, the invoice created in December. So we should be including the full 600,000 in income because we've earned it. But 10% is on condition of the architectural approval. So how much do we include in our business income? And we do it in two steps. Conceivably, in 2025, we would add the full 600,000 to income, but we would subtract out the conditional amount, the condition on the architect. So of 2025, 600,000 minus 10%, $540,000 would be recognized in this period. And then in January, after the approval's given and that condition is removed, now the additional 60,000 will be included in income then. So the 600,000 is partially spread out over these 2 years. So we recognize this income on an accrual basis. We haven't actually received the cash, but we're still reporting the income and paying taxes on it. So, what happens if we receive amounts in advance? So, accounts receivable says, okay, we're owed amounts. Sometimes we might get a deposit or a down payment. We're receiving amounts. So, cash basis or the Tax Act commonly says you receive dollars, that's income, but we have not yet earned that income yet. So, it's included in business income, the amounts received for services rendered in subsequent year, products delivered in subsequent year. So either we haven't performed the service or we haven't delivered our product. We're allowed to take a reserve to offset amounts received, except for refundable deposits. Does it go into, it goes into the reserve concept, but I wanted to jump here for quality of income. Quality of income says something has the quality of being income if there's an unconditional right to the amount. In other words, we received cash. Is there any situation where we might have to give the cash back? If the answer is no, then it's income. So someone gave us a deposit, we're going to provide a service. But then they cancel the service. We never gave it to them. We didn't earn it, but we're not giving the amount back. It's a deposit, it's non-refundable. So we still include it in income because there's no condition. They've provided the funds. So why am I bringing that up here? Because it's reflected in that amounts received in advance. Amounts received in advance are recognized in business income, but we get to reserve. We get to subtract that income until we earn it. But if there's no condition where we have to earn it, means they can't get a refund. We're not going to give it back if we fail to uphold our side. It would still be considered an income. So how does that function from this standpoint? You started a health club business in July 2025 that opened its doors to the public September 1st, offering the latest and most sophisticated fitness equipment. Heavy advertising resulted in 200 people joining the club. Contracts were drawn up for a promotional rate of $75 per month with a $400 one-time non-refundable fee if payment for 1 year was made in advance by the end of August. All 200 individuals took advantage of the offer. You received $260,000 in advance payment. So we've received this amount. Cash basis says it's all income, but we can use our reserve structures to figure out the accrual basis, how much should actually be reflected. So $75 per month, that means 12 months, plus $400. So each individual 75 times 12 plus 400. Each individual gave us $1,300 and there's 200 of them, 260,000. So how much of this should be recognized in the current period? Well, choosing December 31st as the year end of the period, how much must we include in business income? We have to portion this out between how much do we owe and how much is still needed to be earned. Or put another way, how much is unconditional to us? How much has the quality of income and how much do we still need to earn in by our year end? So everyone paid up by August. They paid a $400 non-refundable fee times 200. So $80,000 is cash we've received that there's no situation where we'll have to give it back. It's non-refundable. So $80,000 should be recognized. In addition, we should recognize the amount of the gym memberships we've earned. We collected 12 months, so 1 year, but we owe them access to our gym every month until that year passes. So they paid in August, they have access to our gym until the end of next August. But September to December did occur in this year. So we should reflect or recognize the income we've earned for that period. So 75 times 4 months, September, October, November, December, times 200 people, we can recognize an additional 60,000. So $80,000 comes from our deposits, that initial fee that we're not going to be paying back. And $60,000 relates to the monthly memberships that we've earned. So in total, plus $80,000, Of the 260 we received, 140,000 of it should be our final income result between what we've earned and what was given to us unconditionally. The exercise, we calculate it in slightly different parts. We still break out the non-refundable deposits. So $400 times 200 people is 80,000. The fees earned is the additional 60,000. But we still collected 8 months of fees. So we still collected $120,000. This 260 is what's being included in income, but we will be able to subtract our reserve, the reserve being our unearned portion. So we have our 120,000 included, we subtract our reserve of 120,000, we still come to that same net 140 that we calculated on the calculator. So this is the alternative way to get to the same number. So this allows the business income to be reflected on an accrual basis. This 80,000 is unconditional, has the quality of income. The 60,000 is the earned income, and this prepaid amount is unearned revenue. So it gets reserved, and we will make up that income next year as those months pass. So both of these exercises highlight a specific concept, and that is the reserve concept. Reserve concepts is whenever we receive money, we always include the whole amount received in advance in income. So Income Tax Act 12, the Tax Act, just like employment income, is very much written on somewhat of a cash basis, but businesses report on an accrual basis. So these tax sections allow us to modify that cash basis income to get back to what an accrual basis, or at least a facsimile of it, would suggest. So we recognize the full amounts received in income, and then we have a separate claim for a reserve. A reserve subtracts back out the income we should not recognize this year. If a reserve is deducted in one period, we must include it in income in the next period. Once that income has been earned, once it's been substantiated, there's no longer a condition of our ownership over it. So we no longer take reserves. So every year, if we take a reserve last year that's subtracted from our income, it has to be added to income in the next year. And then a new reserve will be taken for the additional unearned amounts. Once we have fully earned, in the example of the gym, once we've fully earned all those memberships, it's fully recognized in income. There's no need to take reserves anymore. So I mentioned quality of income to determine inclusion. An advance has quality of income if there's absolute and unconditional right to the amount, meaning there's no situation where we would have to give it back, and was under no restriction, contractual or otherwise, as to its disposition. So maybe there is a deposit that we will not be refunding, but the deposit has to be spent, say, on materials. If a contractor is renovating your kitchen, they might take a deposit, and in the contract state, this initial deposit is to purchase the materials to start the project, and then you will pay the remainder at the end. Because there's a restriction on its use, we can't recognize that advance in cash, until we've used it for its function. So part of legal determination of when income earned and when it's effectively part of profit. So the general system prohibits deduction of accounting reserves and contingent liabilities. So Section 18 says the reserves and contingent liabilities you accrued for accounting purposes has to be added back to income, and then we'll use specific tax-based reserves to subtract them out again. In this course, we focus on the reserves for bad debt, undelivered goods and services, which is unearned revenue, and unpaid amounts. So we follow the 9, 12, 18, 20. The Tax Act 9 is the starting point for business and property income. This is the profit from the point of view of our accounting principles. Tax Act 18 disallows the initial accounting reserves, and if a reserve deduction is allowed for tax purposes, it comes back in under Section 20. So we would claim that reserve as an expense. The next year, Tax Act 12 says we have to add back any of our reserves to income and establish new reserves for the end of the next year. So focusing on Reserve 1, doubtful and bad debt. So a reasonable reserve for doubtful debts is determined as follows. Separate identification of receivables that are doubtful of collection. Apply percentage based on past history. So you can do it in one of two ways. You can say these specific individuals might not pay. Maybe they've gone bankrupt. Maybe they moved and we can't get a hold of them. Small businesses usually use separate identification because they have a relationship enough with all of their customers that they can identify who will pay and who won't. Large corporations can't do that. When they have tens of thousands of customers, they can't say, oh, Matt Smith will not pay, Jenny Alderos will not pay. They can't just name individual people. So they will apply a percentage. They will say anyone who still has outstanding balance over 90 days, we generally won't be able to collect. Over 60 days, we'll collect probably about 75% of it. So they'll apply percentages to identify their bad debts or their reserve. If bad debt, deduction is permitted if it was included in business income in the year, which means you can't take a bad debt expense unless you've recognized the income. Bad debts recognized if either determined efforts made to collect were unsuccessful and clear evidence to indicate debt uncollectible. Either we can't get a hold of the customer, we can't get them to pay, or they've declared bankruptcy or closed their business. We know we won't be able to collect the amounts. So let's do the exercise for that one. So bad debts reserved for doubtful debts. On December 31st, Norman's Flowers estimates $16,000 of its ending accounts receivable are doubtful. A reserve for that same amount is deducted for income tax purposes. During the 2025 fiscal period ending December 31st, $17,200 in doubtful accounts were written off as uncollectible. At December 31st, 2025, a new estimate of $18,400 was claimed. What is the total bad debt and doubtful debt expense for accounting purposes? By what amount will the 2025 business income for tax purposes be increased or decreased? So let's go through that again to say in 2024, Norman's Flowers initially expensed a reserve of bad debt of $16,000. That was their estimate. In 2025, it turned out that their actual uncollected amount was $17,200. So their expense, their reserve, their allowance was too small. So they have to expense the $1,200 difference. And then a new reserve got created for $18,400. How does this look from a tax perspective compared to an accounting? So from an accounting purpose, in 2025, we would have expensed the allowance, $18,400. We also would have expensed the difference that our allowance didn't account for last year. So an additional $1,200, that means the total bad debt expense is $19,600. This is how it would have been dealt with from an accounting standpoint. From a tax standpoint, it's slightly different. Last year, we would have set up that reserve for 16,000, which means 16,000 has to be added back this year. So this year we add the reserve of 16,000 that 2024 claimed. Then we will expense the actual write-off, 17,200, and then we have our new reserve that we will subtract of 18,004. Notice that the net deduction still negative 19,600. So we come to the same number, it's just the steps are slightly different. From an accounting standpoint, we just recognize the $1,200 overage of bad debt that we didn't account for. From a tax perspective, we add back the reserve and then deduct the full amount, but that net effect is still just the $1,200. And then we have a new reserve for 18,004. The reason we add back the reserves is that allows the CRA to track continuity between the years. If they just allowed the adjustment to reserve of $1,200, from their standpoint, from their side of the tax return, they wouldn't know what this $1,200 is for. Why are you expensing additional $1,200? But by forcing the reserve add back, they can follow. Here's an initial reserve of 16,000. We have its add back and the expense for 2024, and then we have the new reserve. And so it allows them to follow each reserve just into the next year. The net effect is still the same. So it doesn't truly matter mathematically, but it matters as a point of law and structure. So the next type of reserve is goods and services. This is sort of doubtful account. I believe so. And then inventory reserve for unpaid amounts. We're already coming up on 20 minutes, so I think I might end this video here. When we come back, we'll do the next reserve discussion and then go into this inventory reserve of unpaid amounts because it's a larger conversation. So thank you for your time. See you in the next video.